Coach Matt for Tackle Trading here. Gino started this nice little video series called Thinkorswim Tips and Tricks. By the way, Coach G, I love that name for this little video series because all of us here at Tackle Trading, we use Thinkorswim. It's our broker of choice, and we know many of you who are now just starting to learn how to trade. It is your broker of choice as well. One of the things that I really kind of want to make sure everybody is aware of is the risk graph and being able to utilize the risk graph. The Monitor tab is where you have all of your positions listed. The Trade tab is where you make all your transactions. But here in the Analyze tab, this is where you analyze the profit loss at different levels on the risk graph. So here we have a trade on Apple. We have the March 105 call option trade on Apple. Okay, so we're down currently $290. So let's go to the trade, the Analyze tab here, and this will plot basically what we're doing here. So as you can see, right here at the level it is currently, we're down a little bit of money. Here's your break-even point at 111 currently. Now let's say it goes up to 120 over the course of the next month. Well, you're going to make $1,293 over the next month, and that seems really, really good. But one thing we know is going to happen is time decay. And so how much value is it really going to be at 120? Is it going to really, are we really going to make $1,300 based on time decay? So let's go and let's change the calendar there. It's just going down to the date tab. I'm going to click over and let's say 1 month from today. Well, here, if Apple does nothing and just kind of hangs out where it currently is, instead of losing $290, now we've lost $546 based on time decay. And at that 120 level, we're still going to make a little bit of money, but we're going to give up about $100 of the gains based on the P&L based on time decay. So you got to realize that time decay is going to impact the value of your options, and you can change that to see how big of an impact it will based on this calendar right here. So let's go reset that again, and let's go to today. Okay, so we're back to today, and you can kind of see, it's back to $1,300, so on and so forth. Now, let's say we wanted to assess a trade on, say, crude oil. So I'm going to type in crude oil, and I'm going to say, okay, we haven't made this trade yet, but we just want to see what the profit loss is going to look like. So I'm going to go to Add Simulated Trades, and I'm going to go into the March contract, which is 44 days out. That's what it will expire. And I'm going to go sell this delta right here. I'm going to sell the 41 delta. I'm going to right click, and I'm going to sell a single. So this is basically a naked put, and we're just going to do one contract here, just to kind of show you how it works. So now I've simulated a trade. We're going to receive 51 cents for that. Now you would split the bid-ask spread on that. Basically per contract, because there's 1,000 shares there, you're going to receive $510, $10. So now let's go to the risk profile, and as you can see, now it's plotting my reward versus risk. Well, crude oil right now, if you'll go to the chart, crude oil is currently at 53.26. That's the current price of it. So at 53.26, as you can see, we're basically break even. As crude goes up, we start locking in our gains. So as it goes up to $60, we've made $347. As it goes up to $70, we've made $345. As crude goes down, now again, we sold the 41 put contract. As crude goes down to $41, it looks like we're down $3,000. Now that's today. Well, now let's say it takes a month for that entire impact to go. So again, if it goes up to 60, we're making $349. If it goes down to 41, which is not very probable, we're down $3,000. Well, here, let's once again go to the calendar, and let's fast forward just 1 month in time. Okay, now at 41, our loss is only $1,300, okay? So we've dramatically decreased our loss based on time decay. And as crude goes up to $60, we have maxed out our trade, so now we close the trade for a profit. And let's go even more time to the 13th, and now at 41, we've only lost $615. And if so much time decay goes on, at the point of expiration on this contract, which is 44 days out, at the point of expiration, you will have made $510 because those options will expire worthless. That's kind of how time decay works, and you can kind of plot that on a risk graph. So hope that helped in terms of assessing how time decay impacts the risk graph. We'll continue to do the video series called Thinkorswim Tips and Tricks that was started by Gino Poor and continued on through the rest of the coaches. Check us out at the website www.tackletrading.com.